Hi, I'm Tony Roth, Chief Investment Officer for Wilmington Trust Investment Advisors, part of the M&T family. Each year, the investment team spends months poring over data to assess how we believe trends are likely to unfold in the coming year and how it will impact portfolios. Chief Economist Luke Tilley and Head of Investment Strategy Meghan Shue joined me in this video to share just a few of the highlights from our research. Luke, the biggest problem that we have clearly is inflation right now. Everyone thinks that inflation is not going to settle back into a healthy level. We don't think that, but it does seem to be a pretty significant risk.
We do think inflation is going to slow down over 2022 compared to what it's been in 2021. We've just hit over 6% inflation at the end of 2021 here. And I think the way to think about it is inflation, when we talk about it slowing down, is not a decline in prices, but it's less rapid increase in 2022. So there are a few reasons that we think that we'll have less price pressures. First is that we're not going to have massive fiscal stimulus like we did in 2021. And a lot of the inflation is coming from people spending that money and tightening up and using all of those resources, leading to this resource disorder. So we're going to have less spending and less demand for goods. The second one is we still have all of these supply chain issues that we've been talking about, both on the production side, getting people to factories to make things, and then also on the delivery side. So we've already seen some of that easing, and we expect that to happen over the course of this year. And I think one of the really important arguments for less inflation in 2022 is higher productivity by firms. Firms are learning how to make more and are equipped to make more with less. And if they are able to do that, and we're still in a market economy where they're competing for consumers, that higher productivity means they don't need to pass on all of their cost pressures to consumers.
I think it'd be really fascinating, Meghan, to just hear a little bit more about how businesses are, in fact, doing the kinds of things that Luke is talking about. How can technology actually help them overcome those problems?
Technology has been on this rapid acceleration and rapid adoption. And one of the things that has been so compelling about this expansion, I think, has been how quickly that capital expenditure has recovered back to pre-pandemic levels, much faster than any other recession that we've seen. And so I think we've seen companies trying to, in the short term, do whatever they can to survive. And there really are not too many quick fixes for the labor market shortage that we're seeing. So in the short term, companies are sometimes pivoting, making some sacrifices, but longer term, we really expect them to be spending on things like moving to the cloud so that they can be using less company-specific data infrastructure. Automation, even blockchain is going to be really interesting to see how it develops as a technology that can be used, for example, to keep better track and better transparency of the supply chain at every different node. So I think there are so many possibilities.
We've talked about in the past, well before the pandemic, about productivity gains and how something that we like to say is recessions have a way of accelerating trends that were already in place, right? And if you think about the first time you walked through an airport and saw iPads at each of the seats, so people could order and the place could operate much more efficiently. You don't need as many servers. And I can remember thinking, wow, I wonder how long it's going to take. It's going to take forever for restaurants to adopt this kind of technology. But then when you have a pandemic and you've got not just large restaurants, but mom and pop pizza shops adopting apps and QR codes, you get this massive adoption of technology in almost an instantaneous fashion. And that is permanent. It's not like they're going to get rid of their apps now. It's a permanent step up in productivity. That's one of the things that really helps businesses deal with this global resource disorder and also helps with the inflation question that we were just talking about.
Meghan, you have really stressed the need to be diversified based on the idea that we may be going into an extended economic cycle with healthy inflation, but we may not. Take us through how we diversify a portfolio in that environment to try to create the exposure to the growth, but also create the hedge.
We really are at a bit of a fork in the road. I would say that the singular issue that is probably going to have the biggest impact on where we go with the economic cycle is inflation. And so we've been spending a lot of time looking at how different investment opportunities and asset classes and sectors perform in different inflationary environments. So what we've seen is that stocks generally are a very good hedge against inflation. It depends on what kind of inflation, but if inflation stays slightly elevated and doesn't go too much higher or continue increasing, such that it would cause concern that the Federal Reserve is really going to have to step in and put the brakes on the economic cycle, then stocks can perform well.
The question, I think, will be from an economic standpoint, will individuals and families continue to tolerate these increases in retail prices, or will they run out of cash at some point, and then companies will start to have to eventually to reduce their costs?
One of the things that we've heard directly from businesses, large and small, is we have yet to run into any interference or any pushback from customers on raising our prices. And that really comes back to how healthy the consumer is. We're seeing solid job growth on a month-over-month basis. Consumers still have a lot of money tucked away from the previous fiscal stimulus packages and an inability to spend on a lot of services over the past almost 2 years now. And those balances are pretty high. We look at our own internal data. The median household has got a 40% higher level of balances, and that really enables them to spend. And that has driven a lot of these price increases, the ability to spend. But as we know, when we look forward over the course of 2022, we're not looking at that same kind of stimulus. We know that those savings are going to be drawn down. So it's a healthy mix, I think, of job growth, which will help the consumer. And there's enough savings to keep growth going, but not enough that we're going to see the same kind of price pass-through that we've seen over the course of the last year to year and a half.
There's one thing for clients to follow, is the participation rate of the labor market. And we need to see that increase in order to combat inflation.
A lot of the expectations of job growth that we have is built on the expectation that there will be people coming back into the labor market. About 3 million people out right now. We know that maybe half of them have retired, but a lot of them are out either because of still concerns about COVID, and a lot of people are reassessing their need to work. Some of that is built on the savings, but a lot of them we do expect to be coming back in if they deplete those savings and see the need for a job.
I invite you all to read our 2022 capital markets forecast.